Uh, Good afternoon, good morning, wherever you are. Thank you so much for taking the time out to join us and be part of this call. We've got people from all over the country. I hope everybody's doing great. Um, we decided to have a market call despite the fact that capital markets have been totally boring for several months. And there's probably nothing to talk about, right, Josh? But nevertheless, we got a lot of stuff to cover today. So we're here. I'm Kurt Brown, CIO of Town Square Capital, joined today by Josh Flay, Deputy CIO. And then Monica, can we hear you? Monica's actually out on the road, head of our credit group and fixed income here at Town Square. Can you hear us okay?
Hey, good morning. I can hear you guys. Can you hear me?
Yeah, you sound great. You sound great. You
Great.
sound like you're next door. So,
Okay.
so let's dive in. We want to try to keep this call as concise as we can, but there's a lot of topics to cover. What a wild, sort of insane time. I mean, most of us here at the firm studied economics and finance in school, and it's sort of like whatever was in the textbook has sort of been torched to the ground. And we're rewriting a lot of what's in the textbooks. That's what makes, being a part of this business so fun and definitely not boring. So we want to start off by just hitting straight on what in the world is going on and where are we at. And hopefully the slides that we put together in the presentation not only is something that helps you, but most importantly helps you articulate to clients and friends and partners who are people you may work with as professionals to be able to help frame what is going on. It's just such interesting times because it's so challenging now to get quality insight and information out of any form of media. It's almost impossible. Everybody just loves train wrecks and car fires, and it's really hard to sort of just get that data. So hopefully this is helpful to everybody in some way, and the slides will be sent out from this presentation either later today or tomorrow. So you'll have those in your inbox, to sort of refer to. And obviously, we have a Q&A function right here in Zoom. You're all used to using that now. Feel free to send questions. Can't promise we'll get to all of them. We'll do our best, and then we can follow up and sort of go from there in the coming days. Our firm exists to be able to help you. That's why we're here. This is, when I, 30 years ago, when I started my career in New York on the floor of the New York Stock Exchange, it was, you're with all these hardened veterans. And so you sort of think, they've been through it all, they've seen it all. But when things get like this, the way they've been recently, even the most experienced veterans, they get stressed too, so we're sort of all in this together. I was recently, Josh, looking at, I keep in my journal a list of every major market event or concern in my career. And so in 30 years, this is my 23rd S&P 500 correction of 10% or more. And I was kind of looking through my notes and thinking, every one of them felt like the end of the world was upon us. It's sort of like, and yet in that time, the market's up 2,300%. You made 23 times your money in that window of time. So it always feels unique because the circumstances and the factors are always unique.
Yeah, I think there's a weird tendency as individuals to think that whatever's going on right now is going to continue into perpetuity.
Yeah.
Which exacerbates that feeling of, oh no, markets are going down, they're going to continue going down.
Yeah.
When the reality is that's not true. At some point, they're not.
Exactly. So let's try and cut through some of the emotion here and show you some things about where we're at. So one of the reasons it's been such a painful year is there just has not been any place to hide, right? Everybody knows that old, adage about the 60-40 portfolio, 60% stocks, 40% bonds. It's historically been a great portfolio through almost any time. And you look here, this is nearly 100 years. Most of the screen is green, and a lot of it is green by a lot, right? This is the worst combined year for the 60-40 portfolio since 1931 now, right? So what's made this hard is even the parts of our portfolios that normally are ultra stable, like governments, treasuries, things like that, have been really volatile. You can see here over the last year, long treasuries. Now, these are not short bonds. These are long bonds, but long bonds are actually down even more than the NASDAQ 100 or tech stocks. That's very, very rare. How extreme has the selling gotten? This is as of last Friday, okay? So I put this together over the weekend, last weekend. So as of Friday night's close, these were some of the extreme readings that we had seen, right? Very, very rare, like 3 times in 20 years. Weakest reading in 32 years. Only 4 times in 20 years, right? 5th time in 35 years. I want you to remember this slide, mainly because I'm going to show it again in a minute and add some information for you. The point is that the selling pressure and the pessimism got really intense. It got really intense in June, and then it got really intense again in the last couple of weeks. Okay, so really, obviously, what we're all talking about is the combination of what is going to happen in inflation and how is the reining in of inflation going to ultimately affect the economy, bond market, stock market, currency markets, et cetera, right? This is the entire issue right now. You know, it's one of those times where we're talking about almost nothing else because the Federal Reserve has to get inflation under control because it's more dangerous than even recessions, right? Really high inflation is one of the worst things that you could have. Okay, so we're going to show you real quick what is happening in real time. So almost every chart I show you in the next several charts is going to be the last 60 days, okay? So here we have new orders, new manufacturing orders, and new expected orders rolling over and plunging fast, okay? Here's durable goods orders. This is all of the big stuff you buy. This is the washers and dryers and the ovens and things like that. As you can see, also slowing down and slowing down quickly. Here's how much money households are spending when you factor in inflation. So we call it real expenses, right? We're spending a lot less money than we have since 2008 when you factor in inflation. People are sitting on their wallets more. Even commodities. Remember how we were talking about things like lumber, oil, gasoline, and things like this. Earlier in the year, they were going straight up. Now they're going straight down. And you look at what's happened just in the last month or two in the commodities complex. We've really gone from one side completely to the other side, right? This is the report of, can businesses get their hands on commodities? They weren't, they couldn't. And now again, they can. And in fact, they're not even complaining about prices right now. Really a super, super sharp departure just in the last few months. Here's used cars. Remember how painful used cars became during the pandemic? We're now down in used car prices 7 out of 8 months. My brother is a senior guy at Manheim, the largest auto auction in the United States. He says that the inventory on the used car lots in his region in Southern California have just exploded. Everybody is sitting on a ton of used vehicle inventory. All of a sudden, like literally like 120 days, it's been a massive pivot.
And that's going to be deflationary for sure. That's going to start bleeding into the numbers.
And that's really the point we're going to make here is that if you look at the last year, prices are still higher in many parts of the economy. But when you look at what's happening in the last 60 to 90 days, we are eradicating that in a hurry, right? New and existing home sales are rolling over really fast. This is finally kind of making its way into the media, this story. You have a 26-year low in mortgage applications, right? This is what a 6.5% to 7% mortgage will do. When we started the year at what, 2.6, 2.7? And the worst 60 days for home prices ever. Look, more than the financial crisis in terms of drop in housing prices in this country. So quickly, people are sensing that the housing market is cooling off. They're marking down homes, lowering prices and things like that. So it's working quickly. How about getting containers from China to California? Down roughly 57% year over year. That's stunning, right? So a complete collapse right now in the price of shipping stuff from China. And you're only going to have that when what's happening? Demand is waning, right? Clearly demand and ordering is slowing down. And by the way, this is through the period of getting ready for the Christmas season, which is usually the period where the shippers are really feeling a lot of demand. They are not, right? And then this one is a really, really consistent indicator of forward inflation. So you see these manufacturing ISM prices paid. These are what the manufacturers are paying for inputs to build things. Look at how fast it's rolling over. Okay, so tell me, where's this going? I mean, when you look historically at the correlation between inflation and what's happening in manufacturing, they're highly correlated. So this is actually a really weird disconnect even to begin with. So we suspect you're going to definitively see moderating prices here in inflation as a whole. And I put this one in here because food has been one of the most painful parts of the US inflation picture, especially in the last 4 quarters. What we're looking at here is the cost of all the stuff that goes into your food. And you can see how that's really started to roll over here. That's really great because probably now that input that goes into the CPI to price food as that part of the inflation input is also going to roll over here anytime. So the point being, again, if you look at from early last year, yes, we have still seen some stubborn inflation data, but all of the stuff that ultimately leads to the pricing, all of the commodities and things like that are finally really starting to roll over. We're even just at the beginning of the week, we saw some jobs data. There was 1.5 million jobs openings that had been erased from where we had been 90 days ago. So we're in those even most stubborn parts of the market. Okay. So what does this mean then for where we are at in terms of stocks and bonds, like in your retirement plan, right? I'm going to show this again. So here's those readings that we got to last Friday and how extreme they were in terms of pessimism and selling. But look at the red now, okay? So this reading marked the 90 bear market low, right? This other reading here was all market bottoms, right? This one here, in all 4 instances, the market was higher 9 and 12 months later. This one was exactly the reading at the COVID bottom, right? This was the 90 and financial crisis market bottom. And then when you find professional fund managers hedging to the degree they are right now, that's also always marked a market low. So I don't know that last Friday was the low. We saw a massive lift this week in equities and a nice bounce on Monday in bonds, but it's impossible. Nobody knows if that was the low. But the point is that we're getting into some really rare air here in terms of how extreme the pessimism and the selling got. Some of you have seen this. I've shown this on prior calls now, probably for, I don't know, since January or February. And you see each of our cycle lows, short-term lows, sort of here through as the year has been moving on, and comparing that to prior bear markets. When I worked on the floor in New York, and I was just a scared kid, I remember my mentors would always kind of carry this list around. And it was sort of like, hey, when markets get really stressed and they get into a free fall, this is the running checklist. When you check all the items, you're at the bottom. Get in there with both hands and start buying, And basically, we've checked most things on the list from, a real improvement, if you want to look at it that way, from the January checklist, right? But we still do have a couple of kind of weird things that we've seen. The one holdout thing that we have not seen that you see with most market bottoms, big market bottoms, are a real give up by the average retail investor, where they're calling their financial advisor and saying, just get me out. Now, there may be reasons that this time is a little bit different in that area. We've seen a lot of pessimism, and we had so many bear markets in such a short window of time, right? We had 18, COVID, and now, all within a 3 or 4 year period. And I'm wondering if people haven't felt a little bit more like, hey, this is the normal course of things. The other thing that plays into this is in prior bear markets, we've never had households have so much cash on hand. It's very rare. We never seen, and I'm going to show the slide in a minute, households are actually going into this quote recession, and we can debate whether we're in one, but we're going into this recessionary bear market period, and households don't have the kind of debt they normally have, and they have a lot more cash than they normally have. So we're kind of wondering if maybe households are not feeling the stress in the same way. Another thing we like is that we've seen intense amounts of put buying. That's a similar form of people voting with their pocketbook that the market's going to go down. Usually when this happens, you're kind of on the edge of seeing a really big rally in markets. And that's where you get what we had happen Monday and Tuesday this week, right? Here's some stuff that you might like to see, like when we get to this level of oversold in the S&P 500, right? In other words, this many stocks under their 50-day moving average, they're all being sold hard. And another way of looking at this, it's the worst 2% of all days in the data, right? Over the last 20 years. Look at what the forward returns have been. I mean, in any average year, you're going to make 11% in a stock portfolio. But in these periods, 1 year later, you're up 31 or 32%. And over 2 years, up nearly 50%, right? So historically, even if this wasn't the bottom, you're getting into a window here where your risk reward to the upside is really being skewed. And this sort of looks at the exact same thing in a different way. When the markets drop 20% in 6 months or less, all the way back to World War II, what's happened? Well, look at the next 1 year, up 31%, and 100% of the cases, the market's been up and up really big over the next year, right? So again, we're getting there. Okay, some other things that we look to maybe as good news, right? If you turn on the news right now, it feels as if like everything is awful and sort of the world is ending. But corporations continue to run very lean and mean, really optimize themselves through COVID, utilization of technology, the way they're outsourcing parts of their business and things like that. And corporations continue to thrive. You look at earnings, do earnings need to come down? Well, are we going to have an earnings recession? Well, yes. How do you sustain that trajectory of earnings growth, in this country? You cannot sustain that. So we're going to have to see some normalization. And I'm not sure the earnings estimates yet have even really reflected what they need to reflect. So that's one thing that we think needs to happen is earnings expectations are probably still just a little too rosy. We've got to get back down here more towards this trend line. Another thing that doesn't get any run, like no one wants to tell you this on the news because it's not salacious, right? Is that corporations are significantly more responsible with their debt as a group than the U.S. government, right? You're hearing that our country is bloated on debt. Well, if you take the government out, that leaves you with corporations and households, and that has not been the narrative. So when you take the average company in this country and you compare their debt to the value of their equity, right? You look, we're still bumping around 50-year lows here. Now, in saying that, I'm going to show you in a minute, there are a lot of companies you need to avoid like the plague. There's a lot of trash still in the system. And so this doesn't mean you blindly buy any business, but the market as a whole is actually got a really good looking balance sheet. Households are the same way. We've seen a slight change with this uptick in interest rates. We've seen more people, economy slowing, everything got really expensive because of inflation. So you have had some people reach for credit cards, not a lot, but some certain parts of our economy. But still, you look at this, households in terms of their credit worthiness, they still look exceptional. Again, it's still near that 50-year low that we set, sort of coming through COVID. Not even back to where we were before COVID. So the media is going to tell you, oh my gosh, people are drowning and the average person can't make it right now. That's actually not what we're seeing in the data at all. I've shown this before. I want to show it again. Going into the financial crisis as a country, we had about 1 trillion in checking accounts in this country. And then now we're sitting about 9, and it's really hasn't moved. It hasn't even budged. So we have a really liquefied economy, both at the household and at the corporate level. That's what's allowing us as an economy to weather this storm right now, right? It's what's making us move through this situation so much better than we would have had we had this kind of inflation in 2007 or 2008, for example. We're also seeing it with the banks, right? So this goes back to 55, and you can see that this is the amount that when a bank brings $1 in, how much do they lend back out? And we got to a place where we were lending out 105 to 108% of everything that a bank brought in. Well, we're now back down to those 70-year levels that we saw in the 50s, where our banks bring in $1 and they're lending out 60 cents of it, right? So by the way, side note, this is why when you look at your monthly statement from pick your favorite bank, they're paying you nothing still. And even though interest rates have gone way up, historically, they would have paid you more to keep your money in their bank, and they're not, because right here, they don't want your money, right? Look at these two charts. The banks are sitting on an insane amount of cash right now. The last thing they want to do is incentivize you to give them more cash, right? That's not the position that they're in. And by the way, as a side note, for those of you that are sitting on a lot of cash, you actually can have built for you a custom cash management program that would allow you to get more interest than is in your bank. It's something you want to talk to your financial advisor about, because there's a lot of interesting options there right now, where even 1 year ago, there was basically no option to do that. We don't talk about the S&P 490. We talk about the S&P 500. But those top 10 are the darlings, right? The Amazons and the Googles and the Apples, right? If you take them out, this market is trading at about 10 or 11% cheaper than it has for 20 years. I mean, the S&P 490 is starting to have a lot of really interesting values show up into it. Here's another way of looking at it. About 12% of all companies that trade on US stock exchanges are that all of their shares, the value of all of their shares, are trading for the same amount as the cash that they have in the bank. It's pretty rare. It didn't even get there in the .com or in the financial crisis, right? So we're getting back to a place where is the whole market dirt cheap? No, it's a lot cheaper than it was, and yet there are some interesting opportunities sort of starting to show up again. These two charts just simply show that even professional fund managers have gotten very negative. That's rare. Here's another way of looking at very, very similar data. And usually when even fund managers get this pessimistic, it has been an exceptional time to make risk asset investments, right? These are the times you don't want to be investing, right? And these are the times you do want to be investing, right? So just a reminder that even these professional fund managers are prone to feeling that kind of emotion. Many of you know, you hear it in the media, the consumer sentiment index. You see us talk about this a lot. It's such an awesome contrarian indicator. When people report feeling miserable about the economy, even if, by the way, the fundamentals don't point to that, it has historically been a really compelling time to make investments. And you can see that the returns going forward. And by the way, these were some of the worst periods, right? Think about 75 and gas lines, right? Think about the inflation of the 80s or the financial crisis, right? These were great times to make investments. Of course, people reported feeling miserable. Well, we have never, ever seen a reading of 50. Don't get me started on this, because I think a lot of this is because of the media and social media, that people think the economy is actually even worse than it is. But nevertheless, historically, it's an interesting time. Small caps, emerging markets are trading near 20, 30, 40-year lows in terms of how expensive those stocks are and those companies are. Okay, are you driving from here?
Monica, got a couple questions real quick.
Okay, let's do it.
Monica, and somebody that they can't hear me very well, so hopefully you can hear me.
That's because I'm a loudmouth. It's just because it's relational to me.
So 2 questions. What about rents? This question was about inflation, and you saw the data last month. So we had the first time since COVID kind of caused rents to dip, a month-over-month decline in rent costs. And so I think we're starting to hit a tipping point here as far as rents normalizing, and you'll start seeing that bleed into inflation data also.
Well, I think one of the things that's going to play out in rents, it's so interesting now. So simultaneously, we have never, ever had this many homes under construction at the same time in this country. Okay, so there's a truckload of supply coming online, and then you have 6.5+% mortgages and a screeching halt to like this heated activity in housing, right? So I don't know when it plays into rents, but just the math means it's going to help rent, because you're going to have all this new supply coming online, including a ton of multifamily, right? That has been under construction. And that's a great question, by the way, because rents and food and wages have been some of the stickiest, most painful parts of the inflation picture. I don't know if you agree with that.
No, I do. And especially over the last 9 months, rent has been very sticky. And the reality is, if we do have a softening of the economy, which I would argue we're going to see over the next 12 months, that will help the rent picture too, because people will not, the landlords are not going to be able to justify continuing to increase rents.
That's right.
If you have a softening of the economy.
And I think this other question we answered, somebody had asked about why don't banks pay higher interest rates? I think we touched on that. They're so bloated with cash already that they just don't want more cash.
Supply
and I might point out also something that I'm seeing in the bond markets. Sometimes we're looking at CDs as an alternative to some of the things that we're doing in the really short space. And the CD rates just haven't been there. They've been lower than Treasury rates. And that's just a reflection of, the banks want to pay as little as possible for deposits when they don't really need them, which is right now. And so they've been very slow to come up as shorter rates have risen. They're starting to get closer to Treasury notes, but they're still, pretty far off. And that's, again, that they don't have to loan it out, or they don't have a lot of loan demand. And so they don't need a ton more cash, and they're just not being that aggressive on the rates.
Yeah, it's a strange environment, Monica, to see CDs paying less than what you can get for treasuries, especially when you factor in the treasuries. There is a little bit of that tax advantage on a state basis.
Yeah, that's true. That's true also. So yeah, it is highly unusual. It happens from time to time, but again, it's just a function of what rate they need to pay to be competitive, and they just don't need to be that.
Exactly.
Well, I guess we can maybe go ahead and go forward into a little bit of a discussion on the Federal Reserve. Obviously, unless you've been in a cave, you probably heard tons and tons about the Federal Reserve lately. I was just thinking the other day, I don't know that I remember a time in not just my professional career, but even when I was younger and just hearing people talking about the Federal Reserve or interest rates. I don't remember another time since probably Volcker, in the early 80s when everybody was so glued to the Federal Reserve and what they're doing, because it tends to be normally a pretty sleepy area. In normal times in interest rates and fixed income, we have a fairly quiet Federal Reserve. We have a fairly slow moving, movement of interest rates. And we have a normally upward sloping yield curve. Well, we don't have any of those things now. We don't have anything that's really normal. And the Fed has been so much in the news because they have been raising rates much faster than is typical, even in a rising rate environment or a tightening environment. And so everybody has been on edge at every meeting, kind of waiting for, what are they going to do next? This chart just shows the median policy projection. That is, the Fed's projection of where they see this end game, if you will, being on the Fed funds. Where do they see it ending up? And you can see, as we started out earlier in, say, June of 2021, those light gray bars there, you can see we've kind of stair-stepped up as we've moved on, into the year, as the Fed has moved tighter, faster and faster. And so what this just shows you is they see that terminal rate, as they call it, of the Fed funds rate being somewhere around 440 at the end of this year. And that's up dramatically from what they thought it was going to be just a year ago. And, as we go forward, again, they're seeing, higher and higher rates as we get to 2023, although not increasing as quickly. And then you can see, they are now calling for somewhat of a decrease in 24. And that's just, a reflection of they see the chances for recession and a slowdown, and then an eventual lowering of those interest rates as being a possibility sometime either late in 23 or 24. And if we go to the next chart, the next slide, you can see there, the quote there, "Everyone has a plan until they get punched in the mouth." I think that was attributed to
Mike Tyson.
Yeah.
So, and that's kind of been the theme, if you will, of the Fed lately. They talked about the transitory inflation late last year, and they pretty much got beat up on that pretty well. So they have come out in the last 6 months or so, very, very tough talking on inflation. And in fact, some of the words from the last statement of Jerome Powell were taken extremely hawkish. They basically, even though he didn't say it per se, they basically took it as, we're going to take this thing as far as we need to take it to stamp out inflation. And even if that means the labor market has to suffer, even if that means we go into recession, it's kind of a whatever it takes mentality. And so that's really put quite a bit of fear in the last few months into the markets over, just how far they will go and how quickly they might push us into a recession. But, what this chart points out is just that, they have their projections, but they're rarely right. And often step up or step down their projections pretty quickly, depending on the the market conditions. If we go to the next slide, we just talk a little bit about the whole concept of the yield curve inversion, because that's also been something people have been talking about quite a bit. And the yield curve inversion, basically what we're showing here is the 2s to 10s, which is kind of what most people focus on when we talk about yield curve inversion, because it's one of the more widely followed parts of the curve in terms of whether it's predictive of a recession. Whenever the 2-year is higher than the 10-year, we call that an inverted curve, even if it's not a totally downward sloping yield curve. But if those 2 points on the curve are negative, then we think that presages a recession at some point. And the reason is, obviously, if you look back in history, I don't think we've ever had a recession where we didn't have at least somewhat inverted curve right before that. And so there's the feeling in the market that it predicts a recession. It doesn't necessarily always predict a recession. We can have an inverted curve or a slightly inverted curve and not have a recession. That has happened in history a couple of times, but it does typically at some point we get a recession after that inversion. But what I want to point out here is that it's not a cause and effect relationship. So in other words, we don't say, okay, the curve inverted, that therefore is going to cause a recession. It's just a reflection of where the market sees the economy going, because the Fed only controls that front part of the yield curve. They control really just the Fed funds rate, and that influences all of those shorter term rates. So really you could think of it as everywhere from 1 month out to a year is pretty much in the Fed's control, but then everything else is just a reflection of where the general market sees the economy going. And if the general market thinks we're going to get a recession or we're going to get a slowdown, then those forward interest rates, or the projection for interest rates in the future, will decline, and you will get that inversion. So it's really just a reflection that the market thinks we're going to get a recession, and the market is often pretty right about these things. So it generally, does happen. But there is a fear, again, obviously, that with the Fed being so hawkish and so committed to stamping out inflation, that they could be a little overzealous and create more of a recession than we really need to have. And so if we go to the next chart, you can see that the probability of recession as predicted, this is from Bloomberg, what they calculate as the probability of a recession. Right now we've gone back up after, we had a few pop-ups there right after pandemic and a few late in 2019. We're starting to get that probability of recession ticking up again. And it really has been what everybody in the market has been talking about over the last week, is, just how likely is it we get this recession with the Fed. The expectation is that the Fed is going to go another 75 basis points in November, probably another 50 either late this year or early next year. That would get them right in that 440 to 450-ish terminal rate range. And so, the fear then just is that if we're not seeing some submission there in the inflation rates, that they could, again, get a little more overzealous, keep raising rates, and lead us into a recession that we might not otherwise have. Go to the next slide here. I'm just going to quickly touch on the federal debt, the federal budget, just because we've had quite a few questions on this, and specifically some questions on how concerning is the debt, particularly debt as a percent of GDP, what the influence has been on the spending after pandemic, the infrastructure package, all of the government spending and printing of money. And obviously, anytime the government is spending a lot more money, printing more money, it's going to blow up the deficit. And, we've seen this happen right after pandemic. The chart there on the upper right, you can see the deficit, gapping out quite a bit right after the pandemic. It's come back in, but, there's no denying that we are in a state where our debt to GDP is quite high. The chart that we show here at the bottom right is the net debt. And actually, I was looking up some statistics on, how we compare to other nations around the world in this measure. And these measures looked at the total debt to GDP, which is higher. And on that measure, we're at 133%, so more than our GDP. But, if you put that into context, we're not the highest out there in the world. Japan is way up there at 257%. Greece is at 207%. Those are obviously some problem children. We don't want to be in that range. But other larger developed economies in the world, like Canada, Spain, France, Great Britain, they're all in the 100 to 115%. So we're not way out of the ballpark there. Certainly not at any level that would take us out of that realm that we're in, where we are the world's reserve currency. And even, if the deficit were to widen out a bit more, we'd probably not necessarily have a problem there, but obviously, being over 100%, it's not a good picture. And the CBO actually is predicting for that number to rise a bit, for the deficits to rise, due to not only, as we know already, deficit spending since the pandemic, the stimulus money, the infrastructure package, all of those things are increasing spending. We are having increasing revenues, and this is kind of I think a myth out there that the reason our deficits are increasing is because our revenue is not increasing, but that's not really true. Revenue is increasing, and interestingly, a lot of the increase is due to inflation. We don't like inflation when it makes our gas cost more, but it actually is kind of helping the deficit situation a bit there. But spending is rising faster for sure, and so that's a problem. And then there's also the other issue looming out there of the Social Security Fund is projected to run out in about 2035. And so both of those things are going to mean some tough decisions for Congress, for the politicians. And as we all know, they don't make tough decisions very well, particularly when those decisions impact their electability. So that's going to be of some concern, but they are issues that are out there in the future. They're not necessarily going to come to the forefront probably in the next year or so, because that's not how Congress works. They don't address these issues until it becomes a crisis. But the short answer there is just yes, it's a concern, not necessarily an imminent concern, but something that is going to require some action at some point.
Monica, just some interesting stats around this. The weighted average duration of the U.S. government debt is about 5 years. Mm-hmm. And the average interest rate on that debt right now is kind of in the high 1% area. Now, if you look at where 5-year treasuries are right now, it's at 4%. So if we continue down this path and let's say it rolls over and we issue new debt at higher interest rates, at some point our interest rates that we're paying on our debt are going to double if interest rates stay the same as where they're at right now. And I'm interested from your perspective, because I'm sure clients out there are wondering, are you concerned about that? Is that something that people should be losing sleep over? Is the national debt and also the interest rate payments and the potential for that to continue to increase?
Well, two things that give me a little bit of solace in that range. I mean, not that it's not a concern, but you can see from the chart there on the left, the net interest payments as a percent of government spending at 7%. It's not the biggest piece of the pie. I mean, we have more things to worry about when it comes to Social Security and Medicaid. Those are much bigger nuts in terms of just our total spending. But also, I think, and I don't know if it's really reflected, if you just look at the average maturity and the average coupon on the government's debt, I don't think it's reflective of the fact that they've actually layered in a pretty good amount of longer term borrowing over the last, say 7 years or so. I think that rates have been so extraordinarily low. So there is a lot of longer term, lower interest rate debt out there that's going to take a while to work its way through. So I don't think we're looking at any kind of ballooning of the interest payments at this point. And, again, there's just so many other things that are bigger problems. I think probably, the balance of, as I mentioned, revenue is being driven upwards because of inflation. And I think that's going to kind of balance off some of that increased cost due to the higher rates.
Great. And I think the other thing to point out is just the fact that as the reserve currency of the world, like, and we have a printing press, we can kind of print our way out of a little bit of this. Now, that's not a long-term solution, but definitely in the short and intermediate term, it's a solution.
I say it all the time. Like, it is, for all the problems we have, like as much of a dysfunctional family as the United States is, right? We're like the best house in the bad neighborhood, right?
Yeah.
So at the end of the day, as even with the Fed getting behind the curve and printing our way out, where does the world run when they're scared, right? And that's why it's always this idea that we're not going to be the world's reserve currency. And I've heard it for 30 years. Monica, I know you have too. Always kind of makes me laugh,
Yeah.
No, it's true. We are the cleanest in the dirty laundry pile, and I don't think we're going to lose that status anytime soon. Anytime we have crisis events, U.S. And U.S. debt is still going to be the flight to quality place that people run to.
Totally. Great. Okay. Well, let's jump in. I'll go through quickly a few things on inflation. Kurt already covered a bunch, but obviously, right? I mean, headline inflation has come up and it's starting to dip back down. We're seeing core inflation starting to kind of level out, and we think that both of those we're going to see trending down over the next 12 months. And Kurt pointed to a number of different factors. Let's dig into this just a little bit deeper. When it comes to headline inflation, and Kurt mentioned this, right, food makes up 13.5% of the weighting, but when you look at how much of the overall inflation number, it's almost 20%. And with inflation on food year over year at around 11%, that's definitely a big factor, and that's hitting above its weight class for sure. Energy, almost 9% weighting, that makes up almost 25% of the headline inflation number. So definitely, it's an issue, but it's an issue that, as Kurt pointed out with commodities, this is rolling over, and this is actually probably going to be deflationary when we fast forward 12 months. When you dip, let's dive into core. New and used vehicles were major drivers in the past. They make up about 10% of the overall makeup.
And at one point
they were almost 50% of the core number.
Yeah, last year we were having that conversation.
Yeah. So that's starting to roll over. And I actually, like I said, I think this is actually going to be, especially on the used cars and trucks, it's going to be deflationary when we fast forward 12 months. Other things that are stickier, and these are big factors, shelter, that's almost 42% weighting. And we have inflation there at 6.2%. That's going to be sticky, but like we talked about with rents, rents almost 7% inflation.
But think about it. Think about what we already know. Okay, this looks backwards.
Yes.
But right now, with what we know, we just saw the largest 60-day drop in housing prices ever. Okay, you already know that in real time, that number's zero. Right. I mean, at some point, I'm not saying it's like, I don't know when it shows up exactly.
There's a lagging, this is a
lag
factor.
And Monica talks about this a lot. Yeah, go ahead, Monica.
A lot in terms of how actual housing prices get translated into this like owner's equivalent rent, which is an extremely slow process because it's not really baked in there. And then rents themselves actually also take quite a while because you have a cycle of leases. Right. So, I mean, all of that being said, how long do you think that cycle is? I mean, when do we, really?
That's exactly right.
Yeah.
That's why you're probably going to see still a little bit of sticky inflation in the next few prints over the next couple of months. But what's starting to happen is guys and gals in our business are getting worried the Fed's going to overdo it because the vast majority of the inputs are already coming off aggressively. So that's why when you see the Bank of England get off the brakes and start liquefying again, everybody wakes up the next morning and says, well, we're going to have to be right behind that, right? And that's what gives you this hopeful rally at the beginning of the week.
Yes.
And the reality is you probably have a Fed that has to kind of start waiting a little more now to see how this plays out, right? Otherwise, they do run the risk of having a real recession in our country. Not like a technical recession, but like a real one, you know?
Yeah, exactly. Other things, transportation, almost double of, as far as its weighting goes, is how much it contributes. And that's really driven by, airline, only a 1% weighting, but it's making up almost 5% of the inflation number. So obviously we've seen, if anybody's been flying, that the cost of tickets has gone up over the last 12 months for sure.
But even that, so I fly all the time, like every single week.
That's softened though.
The prices have softened, but I'll tell you what's softening is there's open seats.
Oh,
like immediately, just in a few weeks, it's changed for me a lot. And I've been on planes every single week. And before it was like every flight totally full. So I even think that's starting to roll over.
It's good. Good. Here's just another way of looking at this. I just think it's interesting to just see, hey, if headline inflation, and just look at all these other things, lots of food, energy related things, and these are going to normalize.
Well, look at how much of the list was food and energy.
Yeah, exactly.
Right. Yeah. Energy, food, energy.
Yeah. and those things are, and electricity, that's energy, right?
Right.
So it's, this is interesting. This is something that the Federal Reserve puts out, and they look at short and long-term inflation factors, and then they look at a bunch of economists and get their expectations, and then they look at what the market is pricing in, and they put all these different factors into this one metric. And this shows that this is the common inflation expectation. And yes, the reality is has this gone up? Yes, but the long-term inflation expectations are still anchored. And this chart kind of looks like it's a lot. It's not. When you look at these numbers over here, it's not. It's still anchored around that 2 to 2.25%. And I think once we fast forward, and I realize I probably said this last year at the same amount of time, at the same time, that once we fast forward 12 months, inflation is going to be better. I really believe it, that in 12 months, we're going to see inflation coming back down.
Well, the sell-off.
I think it's important also to note that the Fed, what the inflation that they're looking at is the PCE deflator.
Yes.
And I mean, they are looking at CPI, but it isn't their preferred measure. And
That's
so
right.
what's really going to inform their decision making is where that PCE deflator goes, which it's high. It's more like, in the 6% range, whereas CPI is around 8%. But and it hasn't rolled over yet, but it is a lower number.
Yeah, and they really focus on the core PCE, which is in the mid-4s, and so that's definitely a factor. Real quick, fixed income yields. I think this is a very interesting time in fixed income because it's just gotten obliterated in 2022, and I think that's creating a really unique opportunity here. So what I did is,
to quote our friend Mark Ryerson, bonds are sexy again. Did I hear him say that? Or bonds are cool again?
Bonds are cool again.
Yeah, variations of this, but yeah. If you look, this is municipal bonds yield to worst, and you can see here we're just we're right around 4%, which is much higher than the 25-year average, and significantly higher than the last 10-year average. And so it's creating a very, I think, unique opportunity, especially if people are sitting on the sidelines and they've been like, oh, I'm hesitant. I think rates are going to go higher. Yeah, rates may go higher, but the reality is on average, this is a very attractive time to be buying bonds. Investment grade bonds, same story. You look here and you look at the 25-year average and you look at the 10-year average.
Hey, I mean, think about it. I was literally at dinner with a guy last night and saying, when's the last time you could buy investment grade corporates for 5.5? And we didn't have the data in front of us. And I said, the last time I remember doing it was in the financial crisis.
Yeah, exactly.
Like in that window.
Right.
Yeah.
When interest rates were rising.
Yeah.
And then in the financial crisis.
Yeah.
But even before the financial crisis, right? You weren't buying it at 5.5%.
Mark's right.
Yeah.
Bonds are back.
And you look at munis and you look and you're like, yeah, maybe in the early 2000s you could have bought, but the reality is we're in a very different regime from a tax perspective than we were in the early 2000s, which actually make muni bonds
even more attractive, right?
Than they were in the
early 2000s. You're talking about tax equivalent yield now is even more interesting.
When you look at the tax equivalent yield of the munis compared to the investment grade corporates, the spread is over 100 basis points, and that's, we just rarely see that for very long periods of time. So they're, relatively, I think, very, very attractive.
Yeah. And then once you layer in the credit risk, it's even more like from
Yeah.
a risk versus return perspective. I really like munis, and I know I've been kind of pounding the table on munis since last year, but it's very attractive right now. High yield also, you know, relative to historical levels. It's funny because Kurt and I were talking about this, and I said, yeah, you know, with high yield in 6-7% areas kind of normalized. And then Kurt's like, well, I think more like in the 9% area.
Yeah.
And then when I ran the numbers, I was like, oh, it makes sense.
Yes.
I'm thinking about the last like 10, 15 years.
Oh, yeah.
And I've been in the industry.
I'm a little older than you. So
Kurt's been thinking about the last 25 years.
Yeah.
But even in the last 25 years, it's funny because Kurt and I were texting and I was mentioning, I'm like, man, high yield is kind of yielding kind of high 9% area right now. And he's like, that's when you really start getting
well, and think about that. I mean, if I can build a blended corporate portfolio with a little mid-grade bonds and some investment grade bonds, and it's going to pay me 7% a year, let's say that blend of assets, right? That is compelling.
That's compelling.
Because inflation is not 8 anymore.
No.
It's 4 or 5 as we're sitting here in real time, right? And the Fed's going to have to rein this in. That is a really interesting part of your portfolio again.
Yeah. Fixed income is very interesting.
Okay. All right. Let's get this home. I'm keeping my eye on the clock here. So let's drive this across the finish line. I show this chart all the time. I know some of you are sick of it. You can't be reminded of this enough. In the long run, as an investor, you are really investing in the future earnings of anything you're investing in. And what happens is when times get good and people get crazy, they buy digital pictures of monkeys holding bananas for $2.5 million. What do we call those? NFTs. That's insanity. Okay. But when you want to build a great high quality portfolio, and look at this, this is 70 years plus of returns. And look at how correlated they are, the earnings to the stock prices, right? It's not a Ponzi scheme. It's not a manipulated mechanism. That's what investing is. This is another one I love, right? What this basically shows is you had in 87, you had a 34% scary drop in the market, but then the bull market that came after it was 580%, right? Even coming out of 73, which was just such a nasty, nasty period of inflation, right? And 80 as well. Yeah, you had scary bear markets, but then look at what the following bull markets did. So now is the time we're going to make our money, right? You're going to make your money when assets go on sale. You don't make your money when everything is already up, right? So this is where we put the seeds in the ground is right here. We see that this is, pretty normal behavior of the equity markets, right? But we said it at the top, it never feels good. It always feels like the world's ending, but actually it is a pretty normal part of the cycle. I love this. We've got white paper data on this if anybody's interested in it. The truth of the matter is if you had a way to sell your stock portfolio on the day the recession started, and then you could rebuy your stock portfolio on the day the recession officially ended, that's where it's at. But that's not how the world works. Investing is a forward-looking proposition, right? So we haven't seen all of the data in inflation get square yet, but almost certainly asset and risk prices are going to bottom before we do. And literally every cycle we've seen in the last 100 years, that's the way that it's worked.
And that's the rally Monday and Tuesday was people investors expecting that there's going to be capitulation, that the Fed is going to, at some point in the near future, going to have to decrease interest rates.
So you can't control those things. You can control your portfolio though. And that's what we have to control is what we are investing in, right? So we're always obsessing, as you know, about high quality businesses. And by the way, in our line of work, that's not just a marketing term. That there's a mathematical definition for what a high quality business is. Things like high profit margins, a lack of debt, and things like that, right? And so it doesn't feel good when you own a basket of stocks that are down 20%, but it really doesn't feel good when you own trash that's down 60, 70, 80%, right? And you can't afford that. Our retirement plans cannot sustain that, right? So it's always at times like this. What's the Warren Buffett quote? Or it's Charlie Munger, actually. When the water goes out, you find out who's wearing pants or something along that line. You've heard me talk about this for how many years? I don't like it. It's always bothered me. Part of this is a technical definition of what a zombie company is, but however you look at it, when we really got into printing money in this country out of the financial crisis and keeping interest rates really low, it allowed a certain number of firms to exist that probably normally historically would not have existed, right? Heaping up debt on balance sheets and things like that. And so it's never been more critical that you're careful about the nature of the assets that you're investing in. It's not enough just to say, yes, I'm going to buy a little bit of everything. That's not a great solution because our system has some dead wood in it. By and large, our corporations have been pretty responsible with debt and cash, but there's plenty of these zombie companies out there sort of lurking around. So to summarize, our working thesis, we believe the economy is actually slowing pretty quickly right now. Not in like a devastating way. We're not looking for some really harsh recession like we saw coming out of the financial crisis or anything like that. But it's clear we're getting a lot of slowing, and it's all happened in 60 or 90 days. We think that some of the inputs in inflation will stay sticky, but a lot of them are coming our way. That's a good thing. Supply chain is getting worked out. We've seen inventories explode, which of course are deflationary, and it helps the consumer. We really believe that a two-way market is being formed again in real estate. Buyers can do things now in real estate. Buyers were getting completely priced out of the market there for a while. Earnings probably still need to be lower, right? We see this all the time. And earnings are probably just still a little bit too rosy, but they've held up exceptionally well, given the amount of problems we've seen in supply chain, wages, and inflation over the last 6 quarters. We have some lean and mean corporations in this country, right? We talked about this high probability of a shallow recession. Fed's probably not done hiking, but it looks like they could be getting closer. And that's what people are sniffing out right now in a rally like this week, is maybe the Fed's getting to a place where, hey, they do one more hike, get off the brakes, and kind of let the data itself start speaking for what to do next. We're not calling a low in the market, but I showed you a lot of data that would indicate that we're getting at really compelling levels. The problem is, and I'll be perfectly blunt about this, is that when you see this type of pessimism and selling pressure and negativity, you usually are at or near the low in the S&P 500. But here's the problem. The 10% of the time that you're not, there can be another really nasty leg down, right? Like and we've seen that like in the Great Depression or in 08 or in 87, or, pick your favorite scary market window. So you still have to stay strapped in and be prepared. If you wake up one morning and you see that kind of carnage and trading, that probably is the thing that puts in the low, right? That's that last step of maybe having some real fear. We just don't know. But again, you want to control what you can control. And that's really this game plan, right? You want to rebalance your portfolios as you need to. You always learn in both up markets and down markets where you may be too heavy or too light in your portfolio. Correct it, fix it. Just being hopeful is not a strategy. You don't want to be a deer in the headlights. There's things that need to organically be, sort of migrated in your portfolio. Don't be complacent, right? Know what you own and why you own it. It's never too late to sell a bad asset, right? Something that's not functioning, or something that maybe is a poor company, or it could be a private investment you made with your brother-in-law. And we again, the high quality assets, there's probably going to be more volatility. We haven't talked about things like Russia, China, midterm elections. There's all these things that sit out there that can create volatility in the short term, but probably are non-issues as it relates to the core elements of the economy. But they do create noise. A lot of people decided they would never own bonds again, or they would never own value stocks again. And here we are. Bonds look really compelling. So don't abandon important asset classes, sort of in your portfolio. So anyways, those are my prepared comments. What else do you want to add?
No, I think that covers it perfectly. Yeah, I agree with all that.
Monica, anything else you want to add before we let everybody go?
One thing that I kind of neglected to mention when I was talking about recession, and this is a question I get a lot, is, whether we are actually in a recession, because we have had 2 quarters of down GDP. But I just wanted to point out that that's kind of generally what people think of as a recession, but it's actually how the National Bureau of Economic Research defines it, which nobody knows exactly what that is because they don't publicize that. They don't even tell you when they're going to meet and talk about it, but they generally pass judgment on when it's happened at some point 6 months to a year after it's already happened. And one of the things, though, that we think also goes into the equation pretty heavily is employment. And there's never actually been a recession declared without a downturn in employment, and we haven't had that yet. So
that's right. That's right. And don't be, and I know it can be hard. And Monica, you're bringing up the right point here. Don't be dissuaded by something like by being in a recession. Many recessions are complete non-issues. It can be a completely technical thing, right? And so what I have seen in my career, though, is people will be paralyzed by that concept as if they should stop investing or sell good assets that they have or something like that. Recessions are part of the business cycle. We actually needed to slow down. As you can tell from our tenor here, we're glad the economy is cooling off some. We needed that. It helps restore two-way markets and supply chains and wage pictures and things like that. And so don't be frightened out of doing good investing because of the technical classifications. It's a great point, Monica.
Thanks.
All right. With that, thank you so much again for joining us and letting us be part of your portfolio, your retirement planning and whatnot. And obviously, let us know how we can help you out. And we hope everybody has a great fall as we head our way towards the end of the year. Talk to you soon.